Hi guys, welcome back to the CFA Level 1 series. We are continuing to learn financial statement analysis. We are talking about reading 28, which is analyzing income statements. This is revenue recognition part 2. In revenue recognition part 1, I have already covered when to recognize revenue in different scenarios where cash is exchanged at the same time as the product is delivered, when the product is delivered first, but cash is received later. And the third scenario that we covered was when cash is received first and the product is delivered later. Let's continue. So now we are going to talk about how is revenue reported on the income statement. And this is something that is very important. So revenue is reported on the income statement net of any returns and allowances, estimated warranty provisions, and customer discounts. So think of it this way. You are a TV manufacturer. You sold 10 TVs. Each TV cost 1 lakh rupees. So your revenue would be 10 lakh rupees. 1 lakh into 10, which is 10 lakh. But one of the customers returned their TV in 5 days. So what would be your reported revenue? Would you report 10 lakh because you sold 10 TVs worth 1 lakh each? No, because one TV was returned, you would not report that one TV in your revenue. So essentially in this particular example, you would report 9 lakh as your revenue. So revenue has to be reported net of any returns and allowances. Estimated warranty provisions and customer discounts also have to be subtracted from your revenue. So again, I'll give you another example for customer discounts. Let's say the MRP of the TV was 1 lakh, but you gave a discount to your customer and you sold all the TVs at 90,000 each. So the MRP of the TV was 1 lakh, 1 lakh into 10, your revenue is expected to be 10 lakh, but you sold them on a discount. In this case, you sold them for 90,000. So the revenue that you have to report on the income statement has to be 90,000 into 10, which is 9 lakh rupees. Now, I'm going to give you an hypothetical example of how to recognize revenue if you are a construction company that is building a tower. Now, there's a 5-step process for revenue recognition under the converged standards of IFRS and US GAAP. I've not covered what are IFRS and US GAAP in detail, but IFRS stands for International Financial Recognition Standards, and US GAAP stands for United States Generally Acceptable Accounting Principles. For financial statement analysis, you can think of these two as guidelines to make financial reporting. We'll cover this in more detail, but essentially, these two are two different rules under which a company can report their financial statements. Now, coming to the example, there is a contract. Now, what are the 5 steps? We are talking about what are the 5 steps. Let's say a building has gone in redevelopment, a builder has come and he is essentially going to create the new building. So there is a contract. The first step is that there is a contract between the builder and the society to redevelop the building. That's the first step for revenue recognition, that there has to be a contract. The second step is performance obligation in the contract. Now, the performance obligation could be the complete building. The builder has to finish the building, and that would be his performance obligation. Or it could be as soon as he finishes one floor, each floor could also be a performance obligation. So there has to be a performance obligation in the contract. There has to be a transaction price. The transaction price could be 10 lakh or 1 crore to construct the full building. Allocate, the fourth step is allocate the transaction price to the performance obligation. So if the performance obligation were the full building, and if it takes 1 crore to build the full building, then essentially what we are saying is we are allocating 1 crore, which is the transaction price, to the performance obligation, which is the full building. Another example would be if the performance obligation was each floor. So to construct each floor, if it takes 10 lakh rupees, then the transaction price of 10 lakh would be allocated to each floor, which is the performance obligation. The last and final step is recognize revenue when the entity satisfies the performance obligation. So for example, the builder has completed one floor and each floor was a performance obligation, then the builder can recognize revenue with respect to that one floor. When should a company recognize revenue? The next thing that we are going to talk about is when should a company recognize revenue? So it's essential that you only recognize revenue when it is highly probable that reversal is not required. So for example, you would recognize the revenue when the customer cannot return the product anymore. If you've got a 5 day return period, then it is good if you recognize the revenue after the 5 day return period is over. Why do you need to do that? Why can't you recognize it at that particular point in time? Is because if you recognize the revenue and a return is probable, then you would have to do separate accounting for it as well. You would have to create a liability for a refund obligation, because when the customer returns the product to you, you will have to return the money back to them. So on the balance sheet, you will have to create a liability for a refund obligation. And then, of course, you have the right to the returned product. They would return the product to you, you would give them the money back. So you would also have to create an offsetting asset called right to returned goods. If you want to avoid all this, it's better to recognize revenue when it is highly probable that reversal is not required. Next, we are going to talk about revenue recognition for long-term contracts. So revenue recognition for long-term contracts is based on the firm's progress towards completing the performance obligation. Let's take an example, the building example that we took. So what we mentioned was based on the firm's progress towards completing the performance obligation. So, how do you measure the progress towards completing the performance obligation? In the building example, we can measure it from the input side and from the output side. So, if we were constructing a building, let's say that we've used 50% of the total amount of raw materials that are required, then this is what we call as measuring from the input side. We've already used 50% of the total raw materials required, so we would recognize 50% of revenue. It can also be measured from the output side. 2 floors out of 10 floors of the building are ready. If 2 out of 10 are only ready, then I can recognize 20% of my revenue. It's the same builder and society example. Let's take up an example to really drive the point through. The contractor has to build the full building. The price of the building is 20 million US dollars. So the total amount of revenue when the building is completed, recorded on the income statement of the builder, is expected to be 20 million. The cost of construction is only 6 million. So the total cost that the builder is estimating to complete the construction of the building is $6 million. The performance obligation, in this case, the performance obligation is the full building itself. There is no separate performance obligation for each floor, and it is distinctly mentioned in the contract that percentage of costs incurred is appropriate measure of progress towards completion. What does this mean? This means if the builder has used 50% of the raw material that he's expecting to complete the full building, then he can recognize 50% of the revenue as well. So we are measuring it from the input side, not from the output side. As soon as he uses 75% of the raw material, he can recognize 75% of the revenue. Let's see what happens in year one. In year one, and remember, the total cost of construction was expected to be 6 million. 3 million of costs incurred by the builder. So 3 million of the costs has already been incurred in year one itself. 3 million out of the total 6 million required to complete the full project is incurred in year one. So 50% of the costs are already incurred in year one. So because we are using costs as a measure of progress towards completion, therefore the builder can recognize 50% of the revenue. So in the first year on the income statement, the revenue would be 10 million. Let's see what happens in year two. In year two, 1 million costs incurred by the builder. So the total cost again is 6 million. 1 million is incurred in year two. So 1/6 of the revenue of the total revenue can be recognized in year two. So in year two, the builder would recognize revenue of 1/6 into 20 million, that is 3.3 million.